Hi, everyone. Welcome to Halftime 2015. This is Josh Nelson, the CEO and founder of Keystone Financial Services. At Keystone, our mission is to bridge the gap between knowing and doing in the financial lives of our clients. That means we're a little bit different. We're about getting things done. We're about making sure that your priorities are set. And that's what today is about, educating you on the financial markets so you can make better choices with your money. This recorded version of our halftime report is being recorded on September 1st, 2015. The original live version was in July 2015 up at Fort Collins Brewery, and I'm glad that I waited to record this because there's been a lot that's changed, and I think you'll appreciate some of the updates. If you've listened to our forecast or halftime report in the past, you know we like to have a little bit of fun, and we'll start by talking about where we've been. The New England Patriots were embroiled in scandal once again. Back in 2007, they were penalized for videotaping the Jets' signals during a game. This time, the NFL decided it was likely that New England Patriots personnel and quarterback Tom Brady were probably aware of the rules violations. In addition to fining the team and docking draft picks, Brady was suspended for 4 games. 2015 could be called the year of expecting the unexpected. That's because there's a lot of things happening right now, right? Now, June 30th, 2015, the market had actually been doing pretty well up until that point. And again, as of September 1st, now that we're recording this after the market volatility, the market is actually in correction territory right now, certainly looking at the stock market. All these areas, you look at the Standard & Poor's index, the global index, gold, commodities, real estate, really everything is looking at flat to down as of right now. But even as of June 30th, you can see that with the exception of the NASDAQ, most of the U.S. markets really hadn't made a lot of gains. The Dow had actually lost about a point. The S&P gained 0.2%. And again, the NASDAQ was up 5.3% for the period, but those gains have largely been given up at this point as we are in correction territory. Economic performance in the U.S. was lackluster as well. Unemployment has improved and inflation remains pretty low. GDP actually has come out much better than expected here recently reported within the last few days. Again, as of this recording, is starting to accelerate. Now that's, to be clear, GDP in the U.S. Some other areas of the world like China are actually slowing at this point. As you can see on the chart, real GDP increased during the first 3 quarters of 2014, and during the first quarter of this year, GDP decreased at an annual rate of 2.1%. So it's a mixed bag, but I think we're headed in the right direction. We're clearly still in a recovery. According to The Economist magazine, several factors have contributed to slower growth in the U.S., including lower oil prices, which was responsible for slower economic growth in the energy sector, the U.S. dollar gaining value, which caused a decline in exports, American consumers not spending the savings that they had anticipated from lower gas prices, lower oil prices, and finally, that might be an explanation for slow wage growth. Wage growth has been very low with low inflation. While growth in the U.S. slowed, growth in the Eurozone accelerated. Many of the region's large economies, including those of Spain and France, delivered relatively strong GDP growth during the first quarter of 2015. As a whole, the Eurozone grew by 0.4% during the quarter, which outperformed the U.S. The European Central Bank took a page from the Federal Reserve's playbook and began their own round of quantitative easing, and the goal of that was to spur economic growth. It proved effective because the euro area began showing some signs of recovery. The euro lost value against the U.S. dollar, which again is a good thing because it means that they can increase exports, they're more competitive, and Eurozone consumers have been spending the windfall created by the lower oil prices. They've benefited from this as well in dollars in their consumers' pockets, but the difference again is that their consumers are spending it right now, which is helping their economy. So the stimulus from the European Central Bank and negative interest rates did spur economic growth in the euro area. It's been working so far, and it's made European markets more attractive as well. You can see that the various indices here, the UK, France, Germany, all have seen some pretty decent performance here recently, certainly outperforming year-to-date as of June 30th against the U.S. markets. When this slide was originally created, the concern was about the stock market in China being overvalued. Now, as you probably know, the overall market, not just China, but the overall market is in correction territory, largely because of actions by the Chinese government. They've devalued their currency, and there's uncertainty around are they going to continue doing that. And number two, why did they do that? Really, how bad off is their economy? Maybe it's much worse than we're being led to believe. And again, they're the world's number 2 economy, so it bears watching very closely. A lot of volatility being created around this because the market hates uncertainty. Chinese investors' extreme enthusiasm diminished late in the first half of this year. The SSE composite rose more than 59% from the start of the year through June 12th. I hate to deliver bad news, but that's all been given up at this point. In the month of August, the Chinese market pulled back considerably, and their bull market came to an abrupt end. Chinese stocks weren't the only volatile investments during the quarter. Government bond markets were remarkably volatile. For decades, government bonds have been sought as safe havens during tumultuous times, but so far, during 2015, they've been providing the tumultuous times. Government bond values in the U.S. and overseas have been volatile, and Barron said the problem is a lack of liquidity in fixed income markets. Why are bond markets so volatile? Barron's magazine suggests 2 possible reasons. High-frequency trading, in other words, computer trading, can result in herding behavior. Secondly, the scarcity of market makers. In the past, banks made the markets, buying and selling for their own accounts, which created liquidity, but new post-crisis regulations have curtailed those activities. No matter the reason, government bonds have not been behaving in the way markets would expect. In fact, when you consider what's happened across markets and economies so far, a good slogan for the first half of 2015 might be, expect the unexpected. Now, let's take a look at where we are. We'll stick with our sports scandals. Embroiled in another sports scandal was FIFA. The U.S. Attorney General leveled federal racketeering, wire fraud, and money laundering charges against 9 current and 7 former FIFA executives after a lengthy investigation into FIFA that uncovered decades of bribery, totaling more than $150 million. It'll be a while before we know how FIFA's woes are resolved, so let's turn our attention to economics. Things look a little rosier for some countries than others. Quantitative easing helped encourage economic growth in Europe during the first half of the year. However, events late in the quarter had a dampening effect. Also note that Russia and Brazil, both very commodity dependent as far as exports, are both experiencing pullback and recession. For much of the first half of the year, Greece was in the headlines. In the financial markets, they were unable to reach agreements with the International Monetary Fund, the European Union, the European Central Bank on reforms. This has largely been resolved at this point, but there was a lot of volatility earlier on in the year around Greece, and basically everybody was waiting impatiently to see whether the EU would bail them out. As of right now, that has happened. So Greece is officially out of the headlines for the time being, and the attention is focused on China and many of the emerging markets. The financial markets have been wondering for quite some time when the Fed will finally begin to raise interest rates and how global markets will react when they do. It's possible that the events in Europe and China will delay the Fed actions into 2016. Consumers of all wealth levels have benefited from lower oil prices, and lower oil prices have also proven the resilience of U.S. oil producers, as most have not cut production. While the United States has long been recognized as an economic power, some believe that our influence is declining compared to Asia. And the most difficult, let's talk about the future, where we may be going in the future. It's really hard to know what's on the horizon. Could be another sports scandal, could be continued economic improvement and economic decline, bull markets, bear markets. Let's see what the experts have to say about that. Although he said he hopes he's wrong, former U.S. Treasury Secretary Larry Summers believes developed nations may be suffering secular stagnation. And what is secular stagnation, you might ask? Well, it's characterized by low or no growth, weak inflation, low interest rates, and that savings are exceeding investments. For example, infrastructure, education, other things that are critical to future economic growth. Those would all kind of describe what secular stagnation is. So Larry Summers is wrong, according to Ben Bernanke, our former Fed chairman. His inaugural blog posting challenged Summers' views on economies and secular stagnation, and Summers responded to him. It was an economic throwdown. The Wall Street Journal described the encounter that two of the biggest names in the macroeconomics met on the battlefield. So for those of you who aren't into economics, you're probably really bored right now. But obviously, not everybody is agreeing on how this is all going to play out. The IMF, the International Monetary Fund, it does have a positive short-term outlook at least. Relative to last year, the outlook for advanced economies is improving, while growth in emerging market and developing economies is projected to be lower, primarily reflecting weaker prospects for some large emerging market economies, think China, and oil exporting countries. So, The Economist reported for the first time in 2007 that the IMF expects every advanced economy to expand. Growth in developed countries should exceed 2% for the first time since 2010. But when the IMF looks to 2017 and beyond, however, they say growth may be slow. Advanced economies are projected to grow at more modest rates from 2017 onward. So it's a mixed bag of information. Good in the short term, maybe slower in the long term. Investment and financial expert Ken Fisher is optimistic about financial markets and believes that the bull has further to run. He says, you've seen the headlines: China meltdown, Greece collapsing, Brexit risk bashing UK businesses, U.S. debt bomb, Europe's quantitative easing failing, stocks overvalued. Widely known fears aren't risks, they're gifts, right? Stocks climb the wall of worry until investors are out of worries and become euphoric, or until a huge nasty surprise knocks them down. Size and surprise or euphoria. We have neither now. Instead, worrying keeps expectations low and euphoria at bay, lengthening our bull market. We hope Ken's right. Famous bond manager Bill Gross disagrees. But now, successful, neither perma-bearish nor perma-bullish managers have spoken to a sense of an ending as well. Stanley Druckenmiller, George Soros, Ray Dalio, Jeremy Grantham, among others, warn investors that our 35-year investment supercycle may be exhausted. They don't necessarily counsel heading for the hills or liquidating assets for cash, but they do speak to low future returns. Some say that the market's future depends on what the Fed does. One expert writing on the BlackRock blog commented, when you look at S&P 500 performance during rate cycles for various periods going back to the 70s, a clear pattern emerges. Regardless of the period, 3-month returns following the start of a period of steady tightening, that's rate increases, were on average negative and more volatile as markets initially reacted negatively to the start of a tightening cycle. I think that's what we're going to see here soon, right? Markets may have a little bit of a short-term negative reaction to the Fed starting to raise. However, looking out 6 to 12 months, markets rebounded and generally produced positive, albeit subpar, returns. If you look at the chart, you can see the S&P 500 long run ending up ahead of the game even after an initial jolt when the tightening began. So there are those who believe the pain will be short-lived. It's clear from the past few slides that forecasting is not easy. How difficult is it? An analysis of pundit accuracy completed in 2012 found that market gurus are right about 46% of the time, which is less than flipping a coin, right? That may explain why for every opinion there's a counter-opinion. The truth is, nobody really knows in the short term what's going to happen. Today, a lot of very smart people have different ideas about what may be ahead for the global economy and the world markets, but it's a good time to remember that no matter what happens during the rest of 2015, there are likely to be opportunities for investors. They may be in particular markets or sectors or industries or regions, and they may have risks that you need to understand before deciding to invest. But there's usually opportunity to be found in any market. I can assure you that no matter what 2015 holds, we will be here to help. Our disciplined investment process was designed to help you pursue your financial goals. Now, we monitor the market, we monitor the economy, but we don't let the noise of day-to-day events determine our actions. We will not take action until our process indicates that we should. We have confidence in that. It's the reason we sleep well at night. If you have questions, if you have anything that we can help you with, we want to be here to help. We're at 970-744-5408. We're on the web at www.keystonefinancial.org. Remember, we're here to help you bridge the gap between knowing and doing in your financial life. Thank you.